And gentlemen, thank you very much for joining us today for the PIA webinar update. I'm Joy Akub. I'm the Executive Director for Pengana International Equities Division, and joining me today will be our Managing Director, Russell Pillimer, and our CIO and Portfolio Manager of the International Funds, Jordan Svetanovsky. Today, we are looking to provide you with an overview and an update of the Pengana International Limited annual results, performance, and the portfolio update. Please do consider this as an opportunity to ask questions along the way. And if you'd like to ask any questions, just use the Q&A icon at the bottom of your screen, and I'll look to ask them at the end of the session. With that, I'd like to just pass it on straight to Russ. Thanks, Russ.
Thanks, Joy. Good afternoon, everyone. Great to see so many people on the call. Finding that these webinars are working really well, so I hope it is doing what it can for you. PIA, you would have seen on the previous slide, there were three words. If we can just go back to the previous slide, stability, growth, and yield. And this vehicle is genuinely a unique vehicle in the Australian marketplace in that it has delivered and is designed to deliver all three key elements here. A stable a base of assets, good long-term growth in the assets, and finally yield in the form of fully franked dividends. So moving on to the next slide, last year was a good year for the fund. There was good growth in earnings per share, $24 million of after-tax profit. Most importantly, the fund delivered an 11.3% return, which was 6.5% above the index. So that's a fantastic result. But indeed, it's a result that we hope to deliver in a year like we've just had, where the year has been highly volatile and there's been some stock downward movement. So this is an environment that is certainly suited to our outperformance. But a very difficult thing to do to return such a strong return in the year that we've just had. Total shareholder return was 7.6%, and then if you gross it up for our 5 cents per share fully franked dividends, it's a 9.4% grossed up total shareholder return. We are paying a 2.5% dividend in the near future. You can turn to the next page, please. So the key benefits are for our shareholders. So firstly, a consistent stream of fully franked dividends. You might or might not be aware that a few months ago we changed the aim of the portfolio to one whereby we are intent on delivering fully franked dividends and a consistent stream of fully franked dividends. So obviously, as directors of the fund, we cannot guarantee that there will be fully franked dividends into the future. But we've designed it specifically to do this, and we've got a very high degree of confidence in our fund managers that we will be able to achieve this. And as I go through the presentation, you'll see that we've got some definite structural advantages that really aids us in delivering this stream of fully franked dividends, and hopefully you will get a high degree of confidence from these structural benefits. We have sorry, if you can go to the previous slide, we have an excellent team of portfolio managers. As I mentioned, last year was an 11.3% return, but since we took over the fund from the old Hunter Hall management, we generated a double-digit return, 10.2%. And our performance has been consistent across time, both in strong markets and in weak markets. We are the largest ethical LIC on the Australian, on the ASX. We're very proud to be an ethical fund and to be able to deliver such a strong return within an ethical framework. And finally, we invest where others don't. So a lot of the stocks you will see in our portfolio are not stocks that any other fund managers that you invest in will have an investment in. So we go far and wide around the world in different sectors, etc. And we look for great investment opportunities. And as I say, they're very differentiated type opportunities, many of them. And finally, we are designed to provide, we have three key aims: growth, protection of the portfolio, especially in downtimes, and then minimizing volatility. So it's very important for us to grow the funds and to deliver a strong return for our investors. But at the same time, we are very conscious of protecting the downside. When markets fall, we understand our investors do not like to fall as much as the markets fall. And so we're very focused on that. And then also focused on minimizing the volatility in our portfolio. We'll move to the next page, please. So as I mentioned, we're very focused on delivering stable, fully franked dividends. We understand that this is a key requirement in the marketplace. At the moment, there's a bit of a hole in the market where investors have been are unable to source a large number of fully franked dividend paying companies just because times have changed. We're unlike those, unlike many of those companies. We don't have constraints upon us paying dividends. So for a listed investment company, in order to pay dividends, all you need is cash. And we have plenty of cash on hand. Our portfolio is highly liquid. We only invest in liquid stocks. And so at any point in time, if we need cash, cash is readily available. This is unlike, I mentioned we don't have restrictions. Some of the restrictions with other companies in the marketplace might either be because they've got debt on their balance sheets and the debt provider or the bank might have a prohibition on them paying dividends unless certain covenants are met or unless certain circumstances are met. We don't have any of that because we've got no debt. And then also a regulatory requirement. So if you invested, say, with a bank, banks are required to hold a certain amount of regulatory capital. And so unless they are able to achieve that amount of capital, they are unable to pay dividends. We don't have any such regulatory requirements. So all we need is cash. And as I said, we've got plenty of that cash. Moving to the next page. So why I mentioned before that PIA from a structural perspective is extremely well placed to pay stable, fully franked dividends. And this is really because there are two tests to pay fully franked dividends. The first one is a profits test, and the second one is a franking credits test. So on the profits and profit reserves test, what this says is that in order for a company to pay fully franked dividends, the profits in the year in which the dividend is paid or need to be positive, and sufficient to cover the full amount of the dividend that is being paid. If there's not enough profits in that year, then you need to have accumulated profit reserves. Now, in PIA, we have a great structural advantage in that we have $114 million of profit reserves. So sufficient profit reserves to pay fully franked dividends for many, many years to come, even if we don't have profits in any one particular year. So that's a great advantage. The second requirement to pay fully franked dividends is that you have sufficient franking credits. Now, the way you generate franking credits in international LICs is to realize capital gains. So you buy into stock, it goes up in value, you make a capital gain, you sell that stock, you realize the capital gain, and then you pay tax on that capital gain. Now, we are very well placed to be consistently recognizing capital gains. And the reason for this is that we have a very diversified portfolio. So it's diversified across geographies and across sectors. So what we find is that at any particular point in time, some of our companies are doing really well and have gone up in value. And so we're able to take profits from those companies. But the way we manage the portfolio is also particularly well set up in order to ensure that this happens. And that's because our fund managers are highly disciplined in the way they run money. And when we buy into companies and they hit our price targets, the fund managers sell those companies and take money off the table. That's what we do. That's core to how our money, how our fund is managed. And so what we're finding that we have consistently got these stocks where we're realizing capital gains, paying our taxes and generating fully franked dividends. We've been able to do this in the past. And even currently at the moment, we have sufficient franking credits to cover another full year of fully franked dividends. If you can move to the next page, please. ESG investing, I mentioned that this is an ethical portfolio. We say it's ethical ESG investing without compromising returns, and that is that we are able to generate a great track record, double-digit returns since inception within the ESG framework. And we don't believe that the ESG framework hurts our investment proposition at all. In fact, we think that it actually adds to our investment proposition. Next page, please. I mentioned that one of our key aims is to protect capital and manage volatility. And I think this is a part of the strategy where we absolutely excel. And you can see two examples here. The fourth quarter of 2018, when the equity markets were down 11%, we were only down 4.7%, 6.4% outperformance of the market. And likewise, during the first quarter of this year, during the COVID crash, the markets fell 9.3%. We outperformed those markets by 5.2%. So substantial outperformance in these strong down markets. And this makes a big difference to the long-term returns in the portfolio. Next page, please. So just summarizing again, three key aims: grow our wealth, protect the capital, and minimize volatility. And it's done within a very strong ethical framework that does not compromise returns, but in fact even enhances returns. So how do we do it? We do it through three elements. One is portfolio construction. Secondly, we have a very active investment management style. And finally, we have a portfolio with high conviction. We're not there to match an index. We're there to generate these strong differentiated returns for our investors. So I'm going to stop there. I'm going to hand over to my colleague and PM for the fund, Jordan Svetnovsky, and Jordan will talk about how he and the team have been able to achieve what they've achieved, and also about how our portfolio is set up at the moment. Over to you, Jordan.
Thank you, Russell. So if we go on to the next slide. So some of you would have seen some of these slides in the past, but I thought it's worth recapping the core values and the core principles of how we invest, and then go into more detail on what our thoughts are and how we're positioned at this stage. So to begin with, just a reminder on the kind of companies that we invest in. We are essentially the kind of fund manager that really looks for growing companies, high quality growing companies, but we're very disciplined about what price we pay. The commonality across all the companies that we buy is that they must be well managed. So we really spend a lot of time on the quality of the business itself, but also the quality of the management throughout the years and what decisions they've made. Every company that we invest in, we try and invest in a company that has underlying positive tailwinds, which basically says that even if the company trips up here and there, which every company eventually does, you still have this underlying wind behind their back, filling the sails and pushing them along. Some of the positive tailwinds we can talk about that run through the portfolio, I guess, across several stocks. For example, emerging market consumption growth. So we invest in companies that benefit from the emerging market consumer becoming wealthier and being able to afford and consume more goods over time. Another one is the aging population. So we're investing in companies that care for the population as it ages and as its needs change over time. A more recent, more substantial kind of investment, and within that aging population, for example, you will have health insurers, you will have companies that make pacemakers and medical devices and so on and so forth. A third theme we could talk about is something like a digital consumption, digital goods consumption. So games developers, games distributors, and even platforms where kids can stream the type of games that they play and others can follow them. And we think these are the and social media would be another example. And we think this is a kind of trend that will persist and grow over time, and the younger generations will kind of build on this over the next 3, 5, 10 years. And of course, over the years, we've spoken about us being an ESG fund, and we've been ESG aware and avoiding a lot of companies that we talk about leaving the world in a worse off place than it was before. We avoid those companies. But in addition, over the last 6 months to a year, we've implemented a strategy where we invest directly into companies that actually have a net positive impact on the environment or society. So examples of this would be recent additions in companies that, for example, replace plastic containers with cardboard containers, and other examples that we've invested in. Wind energy, we've spoken about Vestas in the past, for example. These are net positives on the planet. And a fourth example would be something like companies that benefit from market disruption, volatility, and think of this more as a counterbalancing kind of feature within the fund, more of a fund portfolio construction theme, if you like. So these kind of tailwinds are common in certain companies that we invest in, but they just help these companies to grow over the long term. Then most companies, we say, are unlikely to blow up. And the way we ensure this is by avoiding companies that have too much debt, for example. In fact, almost all of our companies have hardly any debt. We like companies to be self-sustaining, self-sufficient, and be able to grow through their own cash generation. So we don't invest in companies that have too much debt. And when something goes wrong with these companies, they tend to really go dramatically wrong. So we avoid those companies. We also avoid companies that have too much binary outcome kind of risk. So companies that say, for example, we've got some cure for something, and the whole valuation is riding on them getting that one binary event right. So we avoid that as well. So a lot of our companies, all of our companies, we expect them to just continue doing what they've been doing over time, and that's all we would expect of them. So the second line there that you see is, as I mentioned before, what we believe in terms of valuations is we look at free cash flow yields. We're not big fans of whatever's in vogue at the moment in terms of valuation. So for example, at the moment, with the tech sector being so in focus and everyone investing in tech stocks, you're seeing new multiples that are being talked about. Things like price to sales is now in vogue to talk about that. So you always see these things over time, but we think they're somewhat meaningless. What really matters to us is how much cash is a firm spinning off or is about to spin off. If it's not spinning off too much now, maybe there's in the near future. And then how long does it take us to get our initial investment back or double our money, for example? And that is what we look at. So we look at free cash flow yields as a mode of valuation. And we've been doing this since inception. And most importantly, all of our companies are growing. We like to invest in companies that are winning market share, that are growing over time, so we can hold them over the longer period, and we can provide that kind of stability that we talked about, that Russell mentioned, over time, where we get this kind of stable growth over time. So this is the framework. This is the basic building blocks of the kind of companies that we invest in. In addition, as I mentioned earlier in the thematical kind of discussion, all of our companies have very strong ESG credentials and follow an ethical framework and we all follow an ethical framework that we've put in place since taking over the fund. On the next slide, we see, we reiterate kind of the kind of sectors that we avoid. So things ranging from companies that deal in animal cruelty, so companies that, for example, test medicines on animals, all the way through gambling, mining, nuclear, alcohol. So we've excluded all these sectors. And interestingly, prior to us taking over these, there wasn't a formal discussion about this or process in this. We've instilled a very rigid, a very good and solid process around the ESG framework after discussing it in consultation with the Ethics Centre and internal audits on this. And we continue to improve on this, as I mentioned before, by adding an element of positive screen companies on our investment in our investments. So moving on to the next slide, just again to mention how the portfolio is structured. And this is important because this is somewhat unique in the way we approach the portfolio construction, and that is to say that at all times, no matter what the market conditions, 60 to 80% of the fund is invested in companies we deem as core. So these are wonderful businesses that grow over time, that have high quality management, and they grow 5 to 15%. So we're not talking about companies here that grow 40, 50% a year and all of a sudden they stop growing and suddenly we lose a lot of our investment. These are consistent growers that consistently benefit from certain tailwinds, from them winning market share, having good products, having good management, and good business practices in general. So this gives us the stability of the portfolio, and this gives us that comfort that over time we will give that consistency of returns, given our underlying companies give us that consistency. In addition, the core businesses are very well diversified, so we don't just invest, we don't just hit a rich vein while mining for stocks, and we see this interesting sector and we say, let's go all in tech or all in healthcare because we suddenly find all these great companies. We are very focused on diversifying our businesses. So all of our companies are involved in many different end markets, so that if one of the markets goes wrong for whatever reason during the short term, the others will pick up the slack and we'll get this kind of consistency over time. Obviously, we don't invest in highly cyclical businesses here, but in any case, this gives us that added diversification. The second bucket that we invest in, so that was 60 to 80%, that is the stable core. Then we invest in cyclical and opportunistic companies for the remainder of the fund. So whatever's left is dispersed between these two. Cyclical is 0 to 30%, opportunistic 0 to 20%. Cyclical businesses clearly have an end market that has a more pronounced cycle, which means we have to really focus on understanding the underlying drivers of that cycle. So we try and enter these investments as best as we can at the bottom of their kind of downward trajectory, and then we try to benefit from the kind of the mean reversion of that cycle back to trend. Companies there would include things such as banks, several emerging market companies, because the emerging market countries in general, their economies are quite cyclical because they're tied to, let's say, the fortunes of how China goes or whatever, some industrial cycle in the Western world. In opportunistic, these are companies maybe that where we invest in maybe slightly higher growth companies, but they come with higher risks. So maybe technology companies that are growing faster at the moment. Examples would be something like our investment in Pinterest in the US market. And this is a company that is very interesting, has high potential for great returns, but again, is growing very fast at the moment. And these kind of growth rates are clearly not sustainable forever. And we have to treat it with caution. And that means that in cyclical and opportunistic, we limit how much we invest in them, so we lower the risk, but we also take care of the type of losses, so we run stop losses on these two buckets, so we ensure that we don't lose too much if we get it wrong. So in core, we have the majority of our investments, they're higher positions, and we hold them over a long period of time. In cyclical and opportunistic, as the risk increases in these investments, we limit how much we invest, and we also take care in how we treat them in terms of trading. And that is the fund at all times. So if it's a good market, no matter, if the market's telling us, hey, you should be invested 40% in tech, which is what the market's been telling us in the last 2 months, given the trajectory of NASDAQ, we will stick to the disciplined approach that we've taken over many years. This strategy I've employed for over 15 years, and it's worked because over the long term, it really has produced quite predictable results from my perspective. Now, going on to the next slide, this shows the diversity of companies that we have. It's very difficult to absorb the diversification from just looking at this slide, but visually you can see how we are so well diversified in terms of geographies. But if you cast your eyes on any particular name there, you will see companies ranging from Brembo producing disc brakes for cars, all the way to, say, Dollar Tree, which is a dollar store, hard discount store, Signy is a life insurer, mention Novo Nordisk, which makes diabetes, insulin for diabetics. Then we've got everything to Rakuten, which is a technology company, kind of an Amazon-like company in Japan, to Indian towers, telecom towers in India, and an Indian telco. I haven't mentioned the 38 odd names that we have, but you can, just from mentioning those names, you can see how well diversified the company is. What's interesting here is that this slide is maybe 2 or 3 weeks old, and you will notice that Microsoft and Alphabet on that slide. I can tell you that we no longer have both Microsoft and Alphabet in the portfolio, which means that the fund is now fangless. So we don't have any of the fangs and any of the large cap in vogue companies that have driven the market thus far. So we have stepped away from that train, and we are very happy with the investments that we've put in their place, where we've made the portfolio cheaper, and in fact we haven't compromised quality at all by selling those names. These are wonderful businesses, but they're at the wrong price in our opinion. So moving on to the next slide. Some examples of stocks that we've invested in. Thermo Fisher, we bought this. Some of you may remember when we first discussed this company back in March when it collapsed along with the rest of the market. This is a company we've been monitoring for 2 or 3 years. It's gotten it went quite a long way up and got quite a bit expensive, but with the 40% odd sell-off during the COVID crisis, we found it to be quite an interesting price, and we entered it. This is a typical example of a business that should continue to benefit from great underlying trends, which is the continued need to test, to do medical testing, and these range. They also do a COVID test, for example, but they do many tests. So as the population ages, or indeed as the technology increases in terms of providing health solutions that require more specific targeting, this company will benefit over time. Next slide, please. And this is an example of a company we've invested in recently, which we think is one of the best at what they do, which is basically M&A consultancy, and is the #1 global restructuring advisor. Now, why do we invest in a company like this? Well, clearly the economies globally are not performing optimally, and in fact it's going to get worse before it gets better in our opinion, which means that we'll need consultants to advise companies on whether they can merge with other companies to survive or get stronger out of this crisis, or how can they restructure their debt, or how can they position, how can they deal with bankruptcies, for example. And this company right now, although it is saying that their backlog and their order book, if there was one, if you could think of an order book for these kind of companies, i.e. inquiries for this kind of business, is really increasing, and they expect a very interesting year next year. So this is the kind of company that, again, we invest in thinking about, yes, markets could continue to go up, but what if the economies aren't doing so well? What can we invest in that will actually benefit from such a situation where things are quite stagnant? So this is an example that kind of zigs when the rest of the market kind of zags and goes down. And it's at the right price and top of the game. Again, we invest in leaders and great businesses in their own respective markets. Next slide, please. We've mentioned this one before, but again, as an example of a portfolio construction strength, we think about investing in companies that don't always do well in strong markets, but can actually perform quite well when things get quite uncertain and volatility goes up. So this is an example of a company that we invested in late last year, preparing for whatever may happen, we said, hey, complacency is quite high. We should probably look for some ways to protect the portfolio just in case something happens. So we started building a position in flow traders when no one else wanted to own these shares, it seemed, because the short interest was very high and was very cheap when we bought it. And it performed exactly as planned, in the sense that the share price and their underlying earnings grew quite significantly. So during the March quarter, the COVID crisis, the volatility picked up quite dramatically in the markets, and this company made extraordinary profits, and the share price also reflected that by going up 70% during that period. As you can recall, that's a very good outcome given the rest of the markets collapsed. So on the next slide, we show you how we're positioned at the moment. We're positioned quite away from the benchmark, if you like. We don't manage to a benchmark, but clients tend to think about the S&P 500, tend to think about the global benchmarks, and like to see how we're positioned. And what we can say is where we are quite differentiated at the moment with the rest of the market is that we're quite a long way away from the benchmark in terms of our US exposure. We think the US markets are quite vulnerable at this stage. And so we've lightened up our exposure to the US markets, and where we do have exposure to US markets, it's in companies like US health insurers and other such businesses, and Huli and Loki, which are not by any stretch the favorite stocks at the moment with investors, which means that if there is a sell-off like we're witnessing right at this time, we should be away from all the kind of selling pressure in the market, which we've seen pleasingly in the last several days. When practice matches theory, it's always a nice thing to see. In terms of geography, we are, as I mentioned, away from US, and we are more favoring European companies and emerging markets. And the reason we're looking at Europe is because it's so much cheaper than the US, and we're seeing such great opportunities there. But also, we think the latest bout of ECB kind of the latest bout of, if you like, stimulus that has come in Europe has given us some comfort in the unification of Europe over time, and also from a top-down perspective has given us more comfort in investing in Europe. In terms of market cap, again, i.e. the size of companies we invest in, we are also very much underrepresented in the enormous companies that have been pulling the market up, like Apple, Google, Microsoft, all those companies, Amazon, that are $1 trillion plus, $100 billion and above. We have considerably less than 25% even in the portfolio as we speak. So we have found more value in the 10 to 100 billion mark, which is where we think is a sweet spot at the moment, and also in the small and medium-sized companies. In terms of sectors, we are underweight the technology sector quite heavily at the moment, and we have an energy and industrials, but we're finding some great examples of companies we can invest in other sectors. So moving on, with that, I think I can pass it on back to Russell to conclude here, and we can answer some questions at the end. Thank you, Russell.
Thanks, Jordan. So just recapping, this strategy is designed to deliver consistent, fully franked dividends to our shareholders. And we have whilst we can't guarantee it, we have a high degree of confidence in our fund managers and this systematic advantages within the fund to be able to deliver this stream. The portfolio management team has shown themselves to be excellent at their jobs during good times and bad times, and in particular performing very strongly over falling markets. We are an ethical fund, and the largest ethical fund on the market on the ASX, and we think that's an important place to be. We invest where others don't, and so what you get from us is diversification in your portfolio. Just to summarize our three key aims: firstly, to grow your wealth as shareholders. That's very important for us, but also to protect your capital and minimize volatility. So I'll end there and hand over to Joy, who will ask some questions that have come in through the website. Over to you, Joy.
Thanks, Russ, and thank you, Jordan, for the update and overview of the portfolio. So just to get started with a few questions, Russ, I might just continue with you there. Can you just provide a bit of an overview on the business and how the business is going to be managing the discount to NTA?
Sure. So this is obviously a key aim. As a whole, the international equities LICs are trading at discounts at the moment. We're probably middle of the pack. We've narrowed our discounts over the past few months, and actually in particular since announcing our change in strategy with regards to dividends. Secondly, the key in, so where do we go from here and how do we narrow the discount further? We think it's all about communicating with the marketplace, around the dividends and making sure that people understand that and the implications for that. At the moment, with the current share price where it currently is trading, the dividend yield is 4.4%, and if you gross it up for franking credits, it's a 6.3% a yield. So we think that's a really compelling proposition in the marketplace, especially when you consider, you know, other opportunities out there. We think that's it is compelling. So communicate with our investors around the dividend. Also make sure the marketplace understands what a great job our fund managers have done, which is quite unique. And then finally, just get out there and tell our story. You know, we intend to do that. We've got a big marketing team, and we're actively marketing. Thanks, Joe.
Thanks, Russ. Okay, just moving on to a little bit more about the portfolio, Jordan. With Microsoft and Alphabet being sold, and we know that they were subject to the share price falls that we saw last week, which caused a bit of panic. Can you just provide a little bit more insight into your sell discipline there? And was it done before that downturn?
Thanks, Joy. So just to remind people, when we started this strategy 5 years ago, prior to taking over this product from, you know, this portfolio from Hunter Hall, our team had as our biggest investments, so Microsoft, Google, Microsoft, Amazon, MasterCard, all of these were, Apple was our top position. Now, over time, these companies, and back then they were cheap and interesting and great companies, and we were very comfortable with them. But the way these things have rallied, especially of late, what we say right back at the first slide that I showed, we say that we love these companies that are high quality, that grow consistently. These are wonderful businesses, but we think the market's gone from buy quality at the right price to quality at any price is where we kind of got to last month or so. And when we ran the numbers on Google and when we ran the numbers on Microsoft, which were the last two remaining fangs, if you like, or companies of that order and size, we could not make the numbers work. We couldn't make the valuation work any longer. Now, given they're such a big part of the index and they're performing so well and they have so many fans out there, the temptation is to hold on for fear of missing out and fear of underperforming the benchmark. But that's never what we kind of stand for and never what we stood for in the past. What we say is it's our job to sell things when they get expensive, and we can know, even though we think, well, the market loves them at the moment, they might continue going up, we stick to the discipline. We sell it when we think it's expensive, and we just ensure that we have done enough work on other companies out there, because there are so many companies out there. I refuse to believe that we cannot replace Google and Microsoft when they're so expensive with something more interesting at a better price. So we just continually make sure that we have candidates on the bench that can replace these kind of businesses. And that's what I think makes us very flexible. It makes us be able to look away from the market when it's getting expensive, but also when these companies are cheap enough, we will buy them again. We're not different for the sake of being different. We just stick to our core principles, which is don't own things that are too expensive. Make sure that if the quality is there, and we just keep doing that year in, year out, no matter what the markets are doing.
Thanks, Jordan. Just moving on to another part, which is the fund's exposure to healthcare and health insurance, insurers such as United Health. So what kind of considerations have you placed on the upcoming election and the expectations on the markets, say, if Biden versus Trump were to win?
Okay, well, thank you. There are so many. Okay, I'll divide that answer into two. I think the elections have ramifications not just for our investment in health insurers, but widely, you know, at a wider scale as well on what happens in the markets. Obviously, Biden has, just let's talk about markets first of all. We cannot predict what, you know, everyone thought if Trump won, markets would fall 50%. In fact, they doubled. So just betting on what we think will happen out of these outcomes is probably not a wise thing to do. We don't know what happens. In general, Biden's talked about increasing taxes and repealing those tax cuts that were put in place by Trump, and a few other things that people worry might affect markets overall. But when it relates to the health insurers specifically, we know that during the Democratic primaries, we saw candidates such as Elizabeth Warren and Bernie Sanders talk about Medicare for all and replacing the private health insurance market in the US with a publicly funded one and a publicly administered one. Now, those candidates are not represented on the ticket. It's Biden who has, right from the beginning, from the get-go, said, this is something I'm against. We are keeping the private health insurers, but what we will do is have an option through a private-public kind of partnership to make sure that everyone who needs insurance will get insurance. Now, Kamala Harris also started off initially supporting the Medicare for all, but she has then very soon pulled back from that and has fallen into the Biden camp. Now that means that threat is gone. What the market might be fearing right now is the uncertainty, even though we don't see a risk here. If the Republicans win for the health insurance, that it means that they don't have really a platform or a clear policy in place for health insurance. We don't think that'll change, so therefore that is a positive. If the Democrats win with Biden and Harris, that won't change things dramatically. There was a similar fear going into Obama introducing the Affordable Care Act, and it showed that people like to keep their private health insurance, and that fear didn't eventuate that they would all switch to the public insurance. So we don't think ultimately anything changes. We think this is an opportunity for us to hold strong and in fact build further positions in these companies because over the last 4 years, they've been one of the most consistent companies in the US market, growing 10 to 15% a year through top line, and cash flows have been very consistent, and they're some of the cheapest companies out there. So owning the cheapest companies by a factor of 2 or 3, growing at faster pace than the market, is something we're quite happy about owning for the longer term. So we're very comfortable.
Thanks for that, Jordan. And you know, the portfolio's return over the last year has been 11.3%, which is 6.5% above the index, with a total shareholder return of 7.6%. Maybe just quickly and briefly, could you just explain a little bit of how the portfolio was able to achieve that, just some of the main contributors, the decisions, and please, if you could touch on FX decisions as well over the year.
Okay, so 3 things. Firstly, going into the crisis, we did what we always do, which is like we've done recently with Google and Microsoft. Going into the COVID crisis, we took profit on some companies that were quite expensive even before the crisis hit. Secondly, as the crisis hit, we responded quickly, and we sold 3 or 4 companies that we thought were directly affected by the pandemic, which is the hotel company in China, Amex, and Booking.com, but that had a somewhat limited effect. And thirdly, when the crisis, so that helped us avoid, so being prepared for it just through normal course, normal actions, which we say we do anyway, balancing the portfolio, buying things like flow traders, balancing the risks, which is what we do in any market condition. That was the majority of what saved us from the big collapse during COVID. In addition, we were active and we got rid of some of that pointy end of risk, which is by selling those companies that were affected directly. So that helped us on the way down. But then we were active again at the bottom by reacting and not sitting on our hands, but working the hardest we've ever worked by identifying companies that were cheap. So we have these companies that we've seen over the years that we've analyzed that we weren't happy with the valuations, but as they came down and gave us these opportunities, we reacted and we bought 9, 10 companies right at the bottom, which allowed us to then benefit from a rising market as the market bounced back. We didn't time the market, we just timed the entry of the individual companies. So we managed to buy great quality companies at great prices at the bottom. In addition, at that point, we always say we do take care of the Aussie dollar exposure for our clients because someone has to, and this is a vehicle that allows that. And what we say, we act on 2 conditions. One is at extremes, and the second one is over a longer period. As the Aussie dollar appreciates against a certain currency globally, we will hedge back that currency. If we start losing 10%, every 10%, we will hedge some back. So what happened was during the crisis, the COVID sell-off, the Aussie dollar hit 57 or so, 55.1 in fact, which was the second lowest value versus the US dollar in history. We classify that as an extreme, and we reacted and we hedged a portion of our US dollars back to Aussie dollars. As the Aussie dollar appreciated, the second condition hit, which is every 10% we hedge more. So every 10% we stuck to that rule. We hedged more of the US dollar back to Australian dollars. That allowed us to protect our clients' wealth as the Aussie dollar appreciated against the US dollar. So reiterating, we did normal course of action, protecting the fund on the way down, and we acted as a true active fund manager should. When there's opportunities, we acted not out of fear, but out of opportunity, because we had that frame of mind, because we didn't collapse on the way down. We could react and buy these companies, and we did what we say we would do on the FX side, which allowed us to keep up with the market. Now, similar kind of conditions are forming at the moment, with the US markets having gone vertical, especially the NASDAQ, with retail investors getting heavily involved. Again, we're now stepping away from that heated part of the market, but we're looking for opportunities elsewhere. So again, we're rebalancing the portfolio and the risks so that if something was to happen, we again are in the most optimal kind of position.
Thanks. And we have seen these stretch valuations globally across every, US, different sectors. And so with those stretched valuations, do you find yourself putting more allocation into the core side of the portfolio as a protection mechanism, or do you also see the potential upside with some of the portfolio positions that we have at the moment?
Oh, look, we're finding ideas everywhere, and whether it's core, cyclical, or opportunistic, we really just focus on just buying the best opportunities we can out there, and they come from all walks of life. So we're very open-minded. I think one of the best things about our team is that we have a bunch of individuals here that work as a team that really believe in how we do things. And all of us together are not beholden to one, we're not dogmatic about how we do things. So if we see a great cyclical opportunity, myself as a fund manager will think about whether that amplifies the risk too much for the fund overall. And if it doesn't, if it's a good diversifier, we will add it to the portfolio. So at the moment, to be honest, we're not thinking about strengthening the core necessarily. We're just making sure that we're not in those areas where the rest of the market is really kind of active in, namely tech and namely US, because we are finding opportunities elsewhere. But there we are seeing some extreme valuations, and we would urge, and we are certainly very careful about investing in those markets.
Thanks, Jordan. And you can certainly see the conviction in the approach there, given your, the underweight to the US and overweight Europe, and then completely different sectors and being fangless at the moment. So congratulations there with the conviction. Well, ladies and gentlemen, I'm going to wrap the webinar up now. We just thank you very much for your time, and also thank you very much for the questions that you've sent in. So the webinar will be recorded, and if you've got any further questions, please don't hesitate to contact the team. Thank you, Russell, and thank you, Jordan.
Thank you, everyone.